Right now, as you watch this video, millions of families across Britain are making the biggest financial decision of their lives based on a single assumption that might be completely wrong. They are signing mortgage agreements, stretching themselves to absolute breaking point, and betting everything they have on the belief that borrowing costs will keep falling. Parents are telling their children they have finally found their forever home. Young couples are celebrating getting onto the property ladder after years of saving. Landlords are refinancing portfolios, thinking the worst is behind them. But what if the entire foundation of this property boom is built on sand? What if the very rates that everyone is counting on to keep falling suddenly freeze or, worse still, start climbing again? This is not fear-mongering. This is the uncomfortable reality that nobody in the property industry wants to talk about because the truth might stop the biggest gamble in British housing history. Here at UK Property Point, we exist to give you the honest information that estate agents, lenders, and property developers would rather keep quiet. We have watched this market for years, spoken to countless viewers facing impossible housing decisions, and we refuse to tell you comforting lies when uncomfortable truths could save your financial future. So before you sign anything, before you commit to that purchase or lock into that remortgage deal, you need to understand exactly what is happening and why the next 12 months could change everything for you, homeowners, renters, and investors alike. Cast your mind back to autumn 2022, when Liz Truss announced her mini-budget and the entire mortgage market went into meltdown overnight. Interest rates shot past 6%. Mortgage offers were withdrawn without warning. Estate agents watched helplessly as chains collapsed across the country. Families who had sold their homes found themselves trapped in temporary accommodation because their onward purchases fell through. It was chaos on a scale that nobody had seen in decades. That trauma is still fresh in the minds of millions of homeowners and buyers who lived through it. Now, here we are in 2026, and something remarkable has happened. Rates have been falling steadily. Lenders are tripping over themselves to offer cheaper deals. HSBC nationwide, Barclays, and dozens of smaller lenders have slashed their rates multiple times. Some specialist lenders are now offering deals as low as 3.4% for borrowers who can put down 40% deposits. The mortgage war is real, and on the surface, it looks like wonderful news for anyone hoping to buy or remortgage. But here is where the story takes a darker turn that most people are not seeing. The difference between a 6% mortgage rate and a 4% rate is not just a few pounds here and there. It is absolutely enormous. If you borrow £300,000 at 6%, your monthly payment is approximately £2,000. At 4%, that same loan costs roughly £1,400 per month. That is a saving of £600 every single month, or over £7,000 every year. That kind of difference transforms what people can afford. Properties that were completely out of reach suddenly seem possible. Buyers who had given up hope start booking viewings again. Estate agents report surging demand and bidding wars returning to popular areas. The market feels alive again, buzzing with optimism and opportunity. But here is the problem that nobody wants to acknowledge. Every single buyer entering this market right now is making their decision based on expectations about future interest rates. Financial markets are pricing in a base rate of approximately 3.25% by the end of 2026. That expectation is not just influencing mortgage rates. It is shaping property valuations, driving buyer confidence, determining how much people are willing to stretch, and underpinning the entire property recovery. Estate agents are telling buyers that rates will keep falling. Sellers are pricing their properties based on continued affordability improvements. Developers are launching new projects, assuming strong demand will persist. Everyone from first-time buyers scraping together deposits to institutional investors managing billion-pound portfolios is making decisions based on this assumed trajectory of falling rates. The entire UK property market has essentially placed a collective bet that borrowing will keep getting cheaper. And what happens to bets when the underlying assumption proves wrong? They lose catastrophically. The Bank of England holds the key to whether this bet pays off or blows up in everyone's faces. Their ability to cut rates depends entirely on one thing: keeping inflation under control. And inflation is proving far more stubborn than anyone expected or hoped. Yes, headline inflation has fallen dramatically from those terrifying peaks above 10% in 2022. But the numbers that the Bank of England actually focuses on tell a very different story. Core inflation, which strips out volatile food and energy prices to show underlying price pressures, remains stuck at 3.4%, well above the bank's 2% target. Even more concerning is service sector inflation, which sat at 5% as of January 2026. This measures prices for everything from haircuts and restaurant meals to legal services and gym memberships. When services inflation is this high, it signals that wage increases are feeding directly into prices throughout the economy. Speaking of wages, average pay growth across Britain is running at approximately 5.2% annually. For workers who suffered years of real terms pay cuts during the cost of living crisis, these pay rises are desperately needed and long overdue. But from the Bank of England's perspective, strong wage growth creates a serious problem. Higher wages mean higher costs for businesses, which get passed on to customers through higher prices. This creates what economists call a wage price spiral, where higher wages lead to higher prices, which lead to demands for even higher wages. Central banks fear this dynamic because it makes inflation self-sustaining and incredibly difficult to break. The Bank of England simply cannot cut rates aggressively while wage growth remains this elevated without risking a return to higher inflation. The situation becomes even more complicated when you factor in government policy. The Labour government's budget announced significant public spending increases, including substantial pay rises for public sector workers and major infrastructure investment programs. The Office for Budget Responsibility estimates these measures could add 0.5 percentage point to inflation over the next 2 years. While this spending might boost long-term growth and improve public services that desperately need investment, it adds demand to an economy that is already running hot. When governments stimulate the economy through spending, central banks have less room to stimulate through rate cuts without risking overheating. This creates a fundamental policy conflict where the government wants growth through spending while the bank wants to control inflation through tighter monetary policy. Something has to give, and homeowners might find themselves caught in the crossfire. Global factors make the picture even more uncertain. The Federal Reserve in America has signaled it will maintain higher rates for longer than previously expected. American inflation has proven stubbornly persistent, and the Fed is prioritizing inflation control over growth stimulation. If the Bank of England cuts rates aggressively while the Fed holds steady, the pound weakens significantly against the dollar. A weaker pound makes imports more expensive, directly feeding into British inflation. The UK imports enormous quantities of energy, food, and manufactured goods priced in dollars. Currency weakness translates directly into higher prices for consumers. Global trade tensions, energy price volatility, and geopolitical uncertainty all add further inflation risks that constrain the bank's ability to cut rates confidently. Now imagine what happens if the expected rate cuts do not materialize. Current buyer demand assumes borrowing costs will keep falling. Many buyers entering the market today are stretching to their absolute maximum affordability based on current rates, confidently expecting that when they remortgage in 2 or 5 years, rates will be even lower. But if rates remain elevated or actually increase, these buyers face severe payment shocks when their fixed terms expire. Someone who can barely afford payments at 4% absolutely cannot afford the same property at 6%. This creates forced selling as overstretched buyers cannot refinance or maintain their payments. Forced selling floods the market with supply just as buyer demand collapses. We witnessed exactly this pattern in 2022 when rates spiked following the mini-budget. Transaction volumes collapsed by nearly 30% within months. The current rally is creating the same fragile conditions all over again. Buy-to-let landlords face particularly severe pressure. Mortgage rates for investment properties typically sit 1 to 2 percentage points above residential rates. At current levels, many buy-to-let mortgages carry rates of 6% or higher. Rental income growth, while strong, has not kept pace with these mortgage cost increases. Many landlords are operating at negative cash flow, effectively subsidizing their rental properties from other income sources. If rates remain elevated, more landlords will be forced to exit the market. However, they cannot sell quickly because buyer demand is constrained by the same high rates affecting their refinancing. This creates a standoff where landlords need to sell but cannot find buyers willing to pay acceptable prices. First-time buyers face perhaps the most difficult decisions. They are being told by everyone in the property industry that now is the time to buy before prices rise further. Yet they are also the most vulnerable to rate increases because they typically borrow maximum amounts with minimal deposits. Many sensible first-time buyers are choosing to wait despite seemingly attractive rates because they sense the market is fragile. This caution may prove incredibly wise if conditions deteriorate. Beneath all the rate speculation lies a fundamental truth that will persist, regardless of what the Bank of England does. The UK builds far too few homes. We add approximately 220,000 new homes annually, but need at least 300,000 to keep pace with demand from population growth and household formation. This shortfall has accumulated for decades, creating a structural supply deficit that no amount of interest rate manipulation can solve. Planning restrictions, land availability, infrastructure constraints, and construction industry capacity all limit supply growth. Until we build substantially more homes, particularly in high-demand areas, UK housing will remain structurally unaffordable for most working people. So where does this leave you? If you are watching this and wondering whether to buy, sell, remortgage, or wait, the honest answer is that nobody knows with certainty what will happen next. What we can tell you is that the current property surge is built entirely on assumptions about future rate cuts that are far from guaranteed. The Bank of England faces conflicting pressures from sticky inflation, government spending, global economic uncertainty, and currency considerations. If the expected rate cuts materialize, this rally continues and prices keep rising. If they do not, or if rates must rise to combat resurgent inflation, this property boom does not just slow. It reverses sharply, potentially trapping buyers who borrowed maximum amounts based on optimistic assumptions. The UK housing market in 2026 sits at a genuinely dangerous inflection point. Prices may explode upward if conditions align perfectly, or they may collapse if rate expectations prove wrong. Anyone entering this market needs to understand they are making a highly leveraged bet on interest rate policy over which they have absolutely no control. Make sure you understand the risks before you commit. Make sure you can afford your mortgage even if rates rise rather than fall. And make sure you keep watching this channel, because the next few months could reshape British housing for a generation. If this information has helped you understand what is really happening in the UK property market, consider subscribing so you never miss crucial updates that could affect your housing decisions and your financial future.